Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. Continuing from part 1, we explore the remaining lighting companies struggling to keep up with LED technology and what it means for investors. The transition to modern LED manufacturing is not cheap. It requires significant capital expenditure to retool factories, train specialized staff, and build new supply chains. Companies burdened with high levels of long-term debt simply cannot afford this essential transformation, which locks them into a cycle of obsolescence. A high debt-to-equity ratio signals that the company relies heavily on borrowing to fund operations. When this massive investment is necessary for factory retooling, companies with excessive debt cannot get new loans or must accept high interest rates. This financial strain forces them to delay the LED transition. If interest expenses consume too much of the company's operating profit, there is little cash flow left to finance new research and development or plant upgrades. Slow inventory turnover is the second crucial indicator. Inventory turnover measures how quickly a company sells its stock. A slow turnover rate in the lighting business means the company is holding on to vast quantities of unsold, non-LED bulbs. Every week, these halogen or fluorescent products sit in a warehouse. The risk of them becoming legally banned or technically obsolete increases. This inventory is a ticking time bomb, not a valuable asset. Holding old inventory costs money in warehousing, insurance, and management. This capital is tied up in defunct products, preventing the company from investing in fast-moving, high-demand LED products. Eventually, the company must admit the stock has no market value and take a massive inventory write-down, directly hurting profits and punishing shareholders. We look for the inventory turnover ratio to be significantly slower than their successful industry peers. Failure to secure major commercial or municipal retrofit contracts. The real financial stability in the lighting industry now comes from widespread commercial and municipal lighting retrofit projects. These are large, long-term contracts with predictable revenue streams. They often involve replacing entire lighting infrastructures in shopping centers, office buildings, streetlights, and government facilities. The contracts demand modern LED technology and often include smart controls. If a company is focused on selling bulbs to general consumers or small markets, they are missing the most lucrative contracts available. Companies focused on old tech are simply not qualified to bid on these projects. What signals strong retrofit positioning? Major utility companies often subsidize or manage municipal and large commercial lighting upgrades to meet energy reduction goals. Companies that secure formal partnerships or preferred vendor status with key utility providers show deep integration into the future energy market. Absence of these partnerships is alarming. Look for press releases detailing multi-million-dollar contracts with major commercial real estate groups, larger retailers, or public works departments. These announcements suggest the company has the high-quality certifiable LED products and the supply chain needed for large-scale deployment. Is the company showcasing large industrial-grade LED fixtures, street lighting controls, or advanced occupancy sensors? Or are they still touting the longevity of a slightly improved fluorescent tube? The product pipeline should align with the needs of massive modernization projects. Missing out on these huge recurring sources of income leaves a company vulnerable to volatile retail sales of obsolete products. The competitive gap. Why LED giants will crush remaining legacy players. The disparity between the global lighting leaders and those clinging to outdated filament technology grows wider every quarter. This isn't just about better light quality. It is a fundamental difference in manufacturing scale, technological know-how, and market agility. Big LED companies operate like advanced technology firms. Legacy players look more and more like niche manufacturers, selling a rapidly obsolescing commodity. This performance gap is exactly why we suggest avoiding the non-LED stocks. The giants are not just catching up to the small players, they are preparing to eliminate them entirely through superior pricing and innovation. Price wars and lower margins in commodity lighting. LED lighting has reached true scale. This means the costs of manufacturing chips, drivers and housing continue to fall dramatically. This relentless decline in production cost allows LED giants to keep dropping their retail prices. They can maintain healthy margins on fixtures sold for $5 that would have cost $20 just a few years ago. Now consider the traditional lighting company. They sell incandescent or standard fluorescent bulbs, products that hit peak efficiency and cost reduction decades ago. Their raw material costs for glass, gases, and filaments are relatively fixed. When LED competitors sell a far superior product for a similar price, the legacy company only has one option: cut their own price. When legacy producers slash prices to compete with high-volume LED offerings, they cut directly into their already slim profits. Since their product is inferior and offers no path for future improvement, the price decrease is permanent. Even if a traditional company sells huge volumes of cheap bulbs, the low margin means they barely cover operating costs. They use all their capital just to keep the production lines moving, leaving nothing for research and development or factory upgrades. LED manufacturers benefit from economies of scale. Every new factory and every process improvement makes the next bulb cheaper. Their margin might shrink slightly per unit, but overall profitability remains high because the market size is growing and their technology is constantly advancing. This creates a cycle where legacy players must accept almost zero profit just to clear inventory, while LED giants use falling prices as a tool to capture market share and block competition. Missing the smart home and IoT integration wave. The modern bulb is more than just a light source. It is a networked device. Lighting is now a core component of the Internet of Things and the smart home ecosystem. This integration opens up new revenue opportunities far beyond the initial sale of the hardware. However, firms specializing in traditional bulbs are entirely excluded from this high-value, digitally connected market segment. Smart lighting requires deep expertise in several areas that non-LED companies simply lack: software development, wireless protocols, and server connectivity. These requirements create a huge barrier to entry. Traditional bulbs cannot physically integrate the necessary chipsets, memory, and controllers required for smart connectivity. Their power draw and heat profiles make them incompatible with modern control electronics. The real value in smart lighting lies in linking bulbs to platforms like Amazon Alexa, Google Home, and Apple HomeKit. This requires ongoing software updates and security maintenance, essentially turning the lighting company into a technology service provider. Legacy companies are not structured or staffed to handle this transition. Leading LED companies are moving toward lighting-as-a-service models, particularly in the commercial sector. This involves selling not just the fixtures, but a managed service that includes monitoring, energy optimization, and continuous updates. This model generates recurring revenue. A traditional company can only sell a one-time product, leaving them utterly reliant on sporadic retail sales. By missing the smart lighting wave, legacy players forfeit the chance to move up the value chain. They stay stuck as simple hardware providers while LED giants build robust ecosystems that keep customers locked into their brand for years through connectivity and software features. This technological backwardness guarantees their long-term contraction. The evidence is clear. Non-LED lighting companies face severe headwinds from strict government rules, changing buying habits, and major financial deficiencies. You should treat high dependency on legacy products, slow inventory turnover, and a lack of research and development funding as immediate red flags. Investing in these outdated players means betting against market efficiency and global energy mandates. Smart investors must carry out full due diligence. Examine annual reports to confirm where a company's revenue truly comes from, focusing on the percentage generated by modern connected lighting solutions. Protect your portfolio from obsolescence. Pivot all of your lighting sector investments toward proven innovators. Choose companies building the future of efficient technology, not those trying to sell yesterday's bulbs. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.